Welcome to Thoughts on the Market. I'm Michael Zezas, Morgan Stanley's Global Head of Fixed Income and Thematic Research. Along with my colleagues bringing you a variety of perspectives, today I'll be talking about takeaways from the U.S. presidential campaign debate. It's Wednesday, September 18th at 10:30 a.m. in New York. Last week, Vice President Harris and former President Trump met in Philadelphia for debate. Investor interest was high, and understandably so. As our chief economist Seth Carpenter has previously highlighted in his research, visibility remains low when it comes to the outlook for the U.S. in 2025. That's because the election could put the country on policy paths that take economic growth in different directions. And of course, the last presidential debate in June led to President Biden's withdrawal, changing the race dramatically. So any election-related event that could provide new information about the probability of different outcomes and the resulting policies is worth watching. But as investors well know from tracking data releases, earnings, Fed speak, and more, potential catalysts often remain just that, potential. For the moment, we're putting last week's debate in that category. Take its impact on outcome probabilities. It could move polls, but perhaps not enough for investors to view one candidate as the clear favorite. For weeks, the polls have been signaling an extremely tight race with only a small pool of undecided voters. While debates in past campaigns have modestly strengthened a candidate standing in the polls, in this race, any lead would likely remain within the margin of error. On policy, again, we don't think the debate taught us anything new. Candidates typically use these widely watched events to influence voters' perceptions. The details of policies and their impact tend to take a back seat to assertions of principles and critiques of their opponents. This is what we saw last week. So, if the debate provided little new information about the impact of the election on markets, what guidance can we offer? Here again, we repeat two of our guiding principles for this election cycle. First, between now and Election Day, expect the economic cycle to drive markets. The high level of uncertainty and the lack of precedent for market behavior in the run-up to past elections suggests sticking to the cross-asset playbook in our mid-year outlook. In general, we prefer bonds to equities. While our economists continue to expect the U.S. to avoid a recession, growth is slowing. That bodes better for bonds, where yields may track lower as the Fed eases, as opposed to equities, where earnings may be challenged as growth slows. Second, lean into market moves that election outcomes could accelerate. For several months, Matt Hornback and our interest rate strategy team have been calling for a steeper yield curve, driven by lower yields and shorter maturity bonds. They've been guided by our economists' steadfast view that the Fed would start cutting rates this year as inflation eases. We doubt that policies in Democratic win scenarios would change this trend, and a Republican win could accelerate it in the near term, as higher tariffs would imply pressure on growth and possibly further Fed dovishness. Pricing that path could steepen the yield curve further. And of course, there's still several weeks before the election to get smart on the economic and market impacts of a range of election outcomes. We'll keep you updated here. Thanks for listening. If you enjoy the podcast, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.